Welcome to Video 19A on corporate organizations. So the idea is that taxes are intended to be neutral, and that doesn't mean that there's no cost, but they're supposed to affect the business choices evenly, irrespective of the type of entity that you choose. So Malfoy wishes to start a jewelry store as a sole proprietor. He contributes cash and equipment. The fair market value is $20,000. The basis is $40,000. Because he's contributing to himself, he's just a sole proprietor. Of course, there's no gain or loss realized or recognized. There's no realization event at all because there's no change in ownership rights. Harry also starts a jewelry business, but in what could only be an amazing coincidence, contributes the exact same cash and property, but in this case, Harry forms a corporation. Because Harry and his corporation are separate entities, under our general rule of realization, we have a realization event, and therefore Harry must recognize the gain on his contribution. So you can see as a result, the tax rules clearly would not be neutral if this were the case. That's why I have Code Section 351 that says no gain or loss shall be recognized if property is transferred to a corporation by one or more persons solely in exchange for stock, and immediately after the exchange, such person or persons are in control. So the idea is the rules are designed to prevent treating a sale as a 351 transaction. So what's required for 351 tax deferral, right? Because it basically says no gain or loss shall be recognized. So a transfer of property. So what is property? That's cash, that's tangible and intangible assets. So personal property, real property, intangible assets, those all qualify as property, but services do not. That's compensation. Solely in exchange for stock means you must receive only stock back, but that's kind of only a sort of rule, even though it says solely in exchange for, because you can receive boot, right? So this idea that you receive something in excess of just the stock, similar to a like-kind exchange, we refer to that as boot, and boot can trigger gain but not loss, just like it would in a like-kind exchange. So boot is any non-qualifying property received by the shareholder. So the transfers of the property must be in control of the corporation immediately after the transfer. And in this case, control is defined as ownership of 80% or more. And this is a bright line test. 79.99% does not satisfy the test. It must be 80% or more. Ron and Hermione each transferred to a new corp, property having a fair market value of $5,000 in exchange for the issuance by the corp of 50 shares of its capital stock to each transferor. Is it a transfer of property? Yeah, absolutely. Is it solely for stock? Yes. Are they in control? Yeah, it's a new corporation. They're the only shareholders. So for sure they have 80%. As a result, no gain or loss would be realized or recognized. Well, no gain or loss would be recognized for Ron or Hermione. So in this situation, Ron or Hermione transferred to a newly organized corp, property having a market value of 5 in exchange for the issuance of 50 shares to Ron, 45 shares to Hermione, plus another 500 in cash. So in this case, we definitely have a transfer of property. Is it solely for stock? In this case, no. There's boot of 500 to Hermione. I'm not sure why she's B. Are they in control? Absolutely. So as a result, no gain or loss is recognized to Ron, but Hermione will recognize any gain realized up to that $500 worth of boot, just like she would in a like-kind exchange. Harry and Malfoy each transferred to a new corp, property having a fair market value of $4,500 in exchange for the issuance by the corp of 45 shares. At the same time, the corporation issues to Crabbe 10 shares in payment for organizational and promotional services. So Harry and Malfoy were under no obligation to pay for Crabbe's services, meaning it wasn't like there was some assignment of the deduction here. It was all really legitimately for the corporation, what Crabbe did. So is there a transfer of property? Well, for Harry and Malfoy, the answer is almost certainly yes. Was it solely for stock? For Harry and Malfoy, yes. Are they in control? For Harry and Malfoy, the answer is yes. So no gain or loss will be recognized to Harry and Malfoy, because note that they contributed nothing but property. It was solely for stock for them, and they control more than 80%. They control 90% after the transaction. Crabbe, on the other hand, will have compensation that's taxable as ordinary income based on the fair market value of the 10 shares of the stock he received. So Harry transferred to a new corporation, fair market value $5,000 for 50 shares, and Malfoy just flat out contributes services for those shares. So was there a transfer of property? For Harry there was. Was it solely for stock? For Harry it was. Are they in control? And the answer is no. The folks that contributed that contributed property solely for stock are not in control, because Malfoy contributed services and he owns 50%. So Harry by himself doesn't have more than 80%. So gain or loss is recognized to Harry, and you better believe Malfoy recognizes the compensation on the 50 shares of stock that were contributed to him. So what if Malfoy realizes this and he says, oh, I see, you got to be a property contributor. So I'm going to contribute property with fair market value of $1 and then services for the other $4,999. So the value of the property must not be what they call relatively small, which means it needs to be at least 10% of the value of the other stock. So in this case, $1 is clearly not 10% of the value of the $5,000 of stock that was transferred to Harry. So this $1.499 wouldn't stand, but there is a value that Malfoy could contribute property up to or beat that threshold, and it would in fact meet the 80% control standard. Okay, so Harry owns 100% of Hogwarts. Malfoy wishes to contribute property. So fair market value of $1 million and no basis to Hogwarts for 30% of the shares outstanding. So is it a transfer for property? For Malfoy, yes. Solely for stock, yes. But Malfoy will not be in control. The individuals exchanging property, which is only Malfoy, are only 30% of the control. And so as a result, Malfoy would need to recognize gain. But let's flip this on its side like we did the last one. What if Harry contributed property for 1 share at the same time Malfoy contributed? Well, now Harry owns all the rest of the shares. So collectively, they would meet the requirement, but that same relatively small rule applies here also, is that Harry's 1 share would need to be at least 10% of his outstanding shares for that strategy to work. So as a result, his 1 share strategy doesn't work. Okay. So transfers of property in a 351, the receipt of boot triggers gain up to the fair market value of boot. The boot would be allocated based on the fair market values of the properties transferred, and the character of the gain recognized depends on the nature of the asset transferred. So we have a 351 transaction. Property contributed is land with fair market value of 45, basis 25. Building with a market value of 5 and a basis of 25. And cash coming back for $20,000. So there's the boot. Okay, so when we look at the land, the amount realized is $45,000. That's the fair market value of the stock that you would receive in exchange for that. The basis is 25. That's a realized gain of $20,000. The building, on the other hand, has a $5,000 market value, but a $25,000 basis. That leaves it with a realized loss of $20,000. The boot's going to be allocated based on the fair market values of those properties. So the land is going to get 45/50ths of the boot, and the building is going to get 5/50ths of the boot. As a result, the gain on the land will be recognized up to $18,000. And of course, the loss on the building won't be recognized at all because receipt of boot doesn't trigger loss recognition. Okay, the transfer's basis in stock is generally the same as the basis in the transferred property, so we should be fairly used to this idea of carryover basis. We dealt with it in like-kind exchanges. So George exchanges property with a fair market value of $10,000, a basis of $4,000, and 351 exchange. So George gets stock back in that exchange. His basis in those shares is the same $4,000 that his basis was in the property that he contributed. So if transfer T has property with a basis of $4,000, for stock worth $8,000 plus cash worth $1,500 and other property worth $500. So now we've got boot mixed in here. So we've got the amount realized is $10,000. The basis of the property is $4,000. There's a realized gain of $6,000. Since they received boot of $2,000, he's going to have to recognize $2,000 of gain. So normally the basis would be carryover plus gain minus boot, which would be $4,000. But we need to allocate that basis across. So what would happen is cash is always at basis. So that cash takes basis of $1,500. The stock would take the computed basis of $4,000, and then any other basis would be at fair market value of $500. All right, so here's a calculation for computing the tax basis of stock in a 351. How about the transferee? What about the corporation, right? So what basis do they take in the property they receive? Generally, it's carryover basis. That basis would be increased by any gain recognized by the transferor. So to the extent that Harry or Ron or one of those parties had to recognize gain because they received boot, the corporation also gets to increase their basis for that gain. Let's see. Recall in a like-kind exchange, liabilities are treated as boot. And one of the problems is that, of course, triggered gain recognition. We treated that as boot, and it triggered gain recognition. So the good news is, with a 351 transaction, that is not necessarily the truth. Liabilities are generally not treated as boot, but there are two exceptions. The first is if the liabilities are in excess of the basis of the property that they are associated with. And secondly, if it can be defined as a tax avoidance transaction. So Haggard transfers property. His basis is $40,000, fair market value of $100,000, subject to a $30,000 mortgage to Norbert Inc. in exchange for the $70,000 worth of stock. The realized gain is $60,000, right? So he gets $100,000 worth of stock. He's got basis of $40,000. But there is no recognition since the liabilities would not be boot. They do not exceed the basis of the property. Haggard's basis in the stock, however, is adjusted by the amount of the liability. So the $40,000 carryover basis is then reduced by the liabilities assumed of $30,000. Norbert's basis in the property is not adjusted by the liabilities, however, because realize they just took on the liability. So if Haggard transfers property with a basis of $40,000, fair market value of $100,000, subject instead to a $50,000 mortgage in exchange for $50,000 worth of stock. So his realized gain is the same $60,000, $100,000 minus $40,000, but in this case the liabilities exceed basis, and therefore it has to be treated as boot under 357. The excess of the mortgage over the basis is $10,000. As a result, Haggard's going to recognize $10,000 of gain. His basis in the stock is $40,000 carryover plus the gain minus the boot minus the liabilities assumed. And Norbert's basis in the property is $50,000, which is, remember, the carryover basis plus any gain recognized by the transferor. So if Haggard transfers property with a basis of $10,000, fair market value $100,000, subject to a $30,000 mortgage in exchange for $70,000 worth of stock. Realized gain is now $90,000. It's going to be recognized to the extent of the excess liability, so $30,000 minus $10,000 basis. Haggard's basis in the stock will be reduced to zero. And this makes sense since the gain deferred is $70,000. So if he goes ahead and sells this stock immediately for $70,000, he would end up recognizing the entire deferred gain. All right, so quick summary: assumption of liability, generally not treated as boot. We can calculate the basis of property received by the corporation in a 351 using this particular formula. So sometimes an individual or someone will transfer property to a corporation but will not receive additional shares of stock in return. So what happens is the corporation takes a carryover basis in the property contributed by the shareholder. The corporation could take a zero basis or takes a zero basis in property contributed by a non-shareholder. And the shareholder making a capital contribution increases their basis in the stock by the basis of the property they contributed. All right, that brings us to the end of video 19A. Thanks for watching.